What is up, guys? Mike Wang here, back with another video, this time on Bitcoin. In the cryptocurrency market, there's a saying that you gotta think like a whale to make money. Today, I'm gonna be talking about institutional players related to Bitcoin, which companies and people are bullish or bearish, and for what reason. I'll also provide a non-biased conclusion of how to view Bitcoin for your overall portfolio. So without further ado, let's get started. Let's briefly go over what Bitcoin exactly is. Bitcoin is a digital currency that was developed for peer-to-peer transactions. Unlike conventional monetary transactions, which occur through a centralized bank, Bitcoin transactions take place through blockchain technology, in which there is a distributed network of people who record the transaction information for rewards. The people who participate in maintaining this ledger are called miners. So for the investors on the side of Bitcoin, we can look at two main figures, Cathie Wood from ARK Invest and Paul Tudor Jones from Tudor Investment Corporation. Cathie Wood has recently received a lot of attention for her bullish Tesla call, and her company is well known for investing in disruptive technologies. Paul Tudor Jones is a legendary trader known for his momentum-based trading strategies and is one of the 7th highest earning hedge fund manager. So let's dive right into why institutions view Bitcoin as a good investment opportunity. The first reason has to do with scarcity. Water is a necessary commodity for life, but it's not expensive because it's not scarce. Gold is not a necessary commodity and has relatively less uses compared to water, but its price increases over time due to scarcity. Bitcoin has this characteristic as well. It's scarce in supply as it was programmed to have a supply of only 21 million Bitcoins. In reality, there are even less than 21 million due to a certain number of Bitcoins having been lost. These Bitcoins were kept in a wallet and forgotten by their owners because no one knew that they'd be so valuable one day. Because there is no central entity that can artificially change the amount of Bitcoin supply, it potentially indicates higher value given that there is enough demand. Additionally, we can also see the network effect take place on Bitcoin based on the Bitcoin dominance chart. Initially, Bitcoin was the only cryptocurrency, but alternative coins or altcoins started to emerge in the cryptocurrency realm. As a result, it became important to refer to the Bitcoin dominance chart, which is a chart that demonstrates Bitcoin's relative value to that of the broader cryptocurrency market. In the purple Bitcoin dominance graph, we can see that the dominance percentage ranges between 40 to 60 during times of both bull and bear markets, which reflect the network effect of Bitcoin and people's view of Bitcoin as a digital asset or a digital version of gold rather than a currency. Speaking of Bitcoin as digital gold or digital asset, we can compare it to gold in terms of market cap. Gold has a market cap of about $9 trillion. Bitcoin stands at $288 billion. For a bullish case, even with a rough estimate that Bitcoin can grow as big as 10% of gold's market cap, that would grow Bitcoin's market cap to over $900 billion, which would price Bitcoin at over $40,000 per coin. This analysis, based on ARK Invest's report, has an underlying premise that Bitcoin will eventually follow gold's characteristic as an asset. We can take a look at what Jones thinks of Bitcoin in comparison to cash, gold, and other financial assets as well. He looked at the criteria of purchasing power, trust, liquidity, portability, and calculated the total score. While Bitcoin did come out as last on the list, it's even more important to realize the fact that Bitcoin may still be extremely undervalued. In terms of the overall score, it scored 43 compared to 71 of financial assets, which percentage-wise is 60%, and yet the market cap of financial assets is 1,200 times bigger. Also compared to gold, it scores 66% of gold as a store of value and yet only has a market cap that is 1/60th of gold. So Tudor says, quote unquote, something appears wrong here, and my guess is that it's the price of Bitcoin. Of course, Bitcoin and gold still have massive differences. While gold has a bigger and better network effect, a better image of a safe haven, and a real-life use in electronics and jewelry, Bitcoin has a finite supply, a characteristic that makes it safer as the network effect grows and is easier to keep and maintain than gold. The fourth reason why institutions are looking into purchasing Bitcoins is due to macroeconomic changes. People invest in gold because they view it as a hedge against inflation. Ever since modern society found out that the solution against deflation was simply to print more money, the real value of the currencies we use worldwide have been depreciating over time. In the graph in blue, we can see the M2 graph, which is simply the money supply chart. We can see that the money supply started growing at an exponential rate of 25% a year starting in 2020. This type of monetary policy trend is not confined to the United States and is the most important macroeconomic factor that explains the bullish momentum in all markets, including the cryptocurrency market. Institutions are starting to see Bitcoin as a hedge against inflation and seeing value in Bitcoin as a digital asset. Grayscale's chart on the right-hand side demonstrates that the United States debt to GDP ratio and M2 velocity. M2 velocity is simply the rate at which money is exchanged within the economy, and what this graph demonstrates is how loose monetary policies resulted in money flowing into financial assets rather than into the economy, which resulted in an increasing disconnect between the equity markets and the real economy. From a macroeconomic perspective, there are also opportunities in emerging markets as well. In this graph, assumptions are made on Bitcoin's capturing certain percentages of the global monetary base, excluding the United States dollar, Japanese yen, Chinese yuan, and the euro. Currencies from emerging countries tend to be more volatile and thus have a clearer motive to invest in hedge assets against inflation or currency depreciation. So given that Bitcoin captures 10% of the M2 in emerging economies, its market cap could roughly reach a whopping $1.2 trillion. Bitcoin is an appealing investment as a hedge against political risk as well. It can also be a good way to protect your assets against seizures from the government. ARK Invest doesn't specify the country here, but I assume they're talking about China. This graph demonstrates the probabilities of a corrupt or a misguided regime confiscating personal assets and the potential growth of interest in Bitcoin as a way to avoid one's assets from being unlawfully seized by the government. I haven't mentioned this previously, but as long as you can take good care of your private keys, which is essentially like a password to your Bitcoin wallet, no one will be able to take your Bitcoins away from you. Lastly, it's important to take a deeper look at how Bitcoin supply works. Bitcoin is supplied to miners who record transactions on the blockchain ledger. Bitcoin is granted to them as a form of reward for contributing to the network. Every several years, the number of Bitcoins miners receive decreases over time. This is called the halving. In the first halving, which took place in November 2012, the number of Bitcoin as rewards decreased from 50 to 25. Then in 2016 July, the reward halved again from 25 to 12.5. The third halving event, which took place this year around May, reduced the block reward from 12.5 to 6.25. The overall trend demonstrates that after the halving takes place, for the next 2 years, Bitcoin undergoes a bullish rally. Thus, given that the third halving event took place a few months ago, institutions have their eyes on a unique asset that is beginning another major bullish market cycle. We can also take a look at the stock to flow model, which measures the relationship between the currently available stock of a resource and its production rate. So in the case of gold, the stock we refer to would be the entire amount of gold mined throughout history, while flow refers to the amount that can be newly mined. Gold, which is a monetary commodity, has a high stock to flow ratio between 50 and 60. The World Gold Council estimates that 200,000 tons of gold exists above ground, while the annual supply is about 3,000 tons. Bitcoin similarly has a stock to flow ratio in its upper 50s, as 18 million Bitcoins have been mined so far, and since 330,000 new ones are mined every year. The good news is, this ratio will continue to increase until it reaches over 100 around 2024. As for gold, we don't know what the actual supply is. We could end up finding significant amounts of gold in North Korea, but Bitcoin is finite with a supply cap of 21 million, which makes Bitcoin harder than gold. If you guys made it to this point of the video, please make sure to like this video so the YouTube algorithm can show it to more people. I'm going to continue making more videos like these, so also subscribe for more quality content. Now moving on, we can look at Ken Fisher for a neutral stance on Bitcoin. Ken is the chairman of Fisher Investments and was one of the few people who accurately predicted the COVID pandemic's impact on the stock market, as well as the sharp V-shaped recovery. His stance is that he doesn't know enough about Bitcoin and that he doesn't really need a stance on it, just as he doesn't need a stance on other types of speculative assets. He knows that the cryptocurrency community, referring to the developers who lead the community, consists of extremely smart people, but he has seen smart people do stupid things in the past. One thing is clear to him: Bitcoin is not what a lot of its proponents think it is. By this, he refers to Bitcoin not having value as a currency, but as something else. He is right about this in the sense that the narrative in the cryptocurrency community has changed from Bitcoin is going to be the next world currency to Bitcoin is a digital asset that acts as a safe haven against inflation. Two major figures that represent institutional investors emerge when discussing arguments against Bitcoin. These two people are Warren Buffett from Berkshire Hathaway and Ray Dalio from Bridgewater Associates. For those of you who don't know, Warren Buffett is the most famous investor alive and is well known for his value investing techniques, and Ray Dalio currently runs the world's biggest hedge fund. In 2018, Warren Buffett went on to say that Bitcoin is an asset that doesn't create any value, unlike a farm or a company, which leaves investors not only with what they bought in the first place, but also something that the asset produced. With a non-productive asset like Bitcoin, all you're counting on is whether the next person is willing to pay you more because they're excited about the next person coming along to pay an even higher price on it. This is completely reasonable coming from a value investor like Buffett. One of his main investment styles involved purchasing large amounts of shares of a company and profiting from the dividends over the long term. Ray Dalio, in a similar context, wasn't overly bearish on Bitcoin, but did pose questions regarding his concerns. Dalio said that Bitcoin is not a good store of wealth due to high volatility and does not protect his purchasing power, and that it will most likely be regulated by governments should it threaten traditional fiat. Not to mention the fact that he can't imagine central banks, institutional investors, and businesses owning Bitcoins in their reserves or using it. His main concerns stem from the older narrative of Bitcoin as a currency, but as I have said before, the newer narrative is that Bitcoin holds value as a unique digital asset. There's data to back up rebuttals against these arguments. On the left, we can see the holder versus speculator index, in which a holder was defined as someone who held on to Bitcoin for 1 to 3 years, and a speculator as someone who moved their coins within the past 90 days. Having more holders indicates accumulation, which essentially means it's bullish, and more speculators indicates distribution or bearishness. We can see that after 2018, the number of holders has been growing over time and the number of speculators has been decreasing over time. Similarly, we can see the whale index, which defines whales as wallets that contain more than 1,000 Bitcoins. The increasing number of whale wallets also signal accumulation. So what these two graphs essentially demonstrate are that the increasing amount of holders contribute to reduced volatility, and that the number of speculators decreasing indicate that people are relying less and less on the next fool to purchase their Bitcoins for a higher price. And lastly, that the increasing number of whale wallets also show Bitcoin's function as a store of value and the increasing trust that is put on Bitcoin as an asset. Now let's take a look at businesses. Businesses have recently started jumping on the cryptocurrency trend as well. PayPal has launched a new service that enables its users to buy, hold, and sell cryptocurrencies. This is big news as PayPal can allow cryptocurrency to reach out to over 26 million people, marking the beginning of a potential mass adoption. Square is an American payment solution company, and it invested over $50 million, claiming that Bitcoin aligns with the company's purpose and that it provides economic empowerment and it encourages people to participate in the global monetary system. They ended up purchasing about 4,709 Bitcoins, which is approximately 1% of the company's total assets at the end of the second quarter in 2020. MicroStrategy is a company that provides business intelligence, mobile software, and cloud-based services, and it invested over $400 million in Bitcoin through Coinbase. Interestingly, their investment profits from Bitcoin exceeded $100 million, which is more than their operating profits over the past 3 years combined. Moving on to institutions, one of the main institutional players worth noting in the cryptocurrency space is none other than Barry Silbert's Grayscale. Grayscale is an asset management company that focuses their investments on cryptocurrencies. So aside from Bitcoin, they also own altcoins such as Bitcoin Cash, Ethereum, Litecoin, XRP, Stellar Lumens, and Zcash. Grayscale became the first company to offer a publicly quoted Ethereum investment product in the United States through their Ethereum Trust, which was approved by the SEC. Prior to this, they had the Grayscale Bitcoin Trust become an SEC reporting company as well. Grayscale's assets under management has recently surpassed $10 billion. While this is a lot for a cryptocurrency fund, this is still relatively small compared to the AUM of traditional asset management companies, indicating high potential for growth in the industry. Guggenheim Partners is a global investment firm with an AUM of $270 billion. They recently reported to the SEC that they had the right to spend 10% of their macro opportunities fund to gain exposure on Bitcoin through Grayscale's Bitcoin Trust. This would amount to a $530 million investment. Another institutional player that has shown signs of interest is BlackRock. BlackRock is one of the biggest investment management companies with an AUM of $7.43 trillion. It was said that Rick Ryder, the CIO of BlackRock, speculated that Bitcoin could take some of the shine off gold, possibly one day rivaling the precious metal's unimpeachable stature over the past 5,000 years as a store of value, and hedge against the devaluing of fiat currencies. Adding to this, the CEO mentioned the possibility of Bitcoin evolving into a global asset. So in ARK Invest's report, they conducted quantitative research on the correlation of Bitcoin's price to other assets, stocks, and indices. They looked at the S&P 500, gold, oil, bonds, emerging currencies, real estate, Bank of America stocks, Apple stocks, and Tesla stocks, and their price actions from 2010 to 2020. Results demonstrated that Bitcoin had very low correlation with all other assets, stocks, and indices that were compared. The only asset that demonstrated moderate correlation was real estate, but this isn't completely accurate either because ARK only looked at the price correlations for a short period of time and thus did not take into account the long market cycle real estate properties have. Real estate properties tend to have longer market cycles, and they have been on a bullish rally without any meaningful corrections over the past 12 years. So the fact that Bitcoin is not clearly correlated to any other conventional asset, security, or index is what makes it unique and worthy of including in one's overall portfolio. So the question emerges, how much Bitcoin should we own in terms of percentages? ARK simulated over 1 million portfolios with different percentages of Bitcoin constituting each portfolio anywhere from 0 to 100%. These portfolios included other assets such as real estate, commodities, currencies, bonds, equities, and gold, but the weight of the asset classes were not disclosed. In the actual report, they had other assumptions, such as a case where they limit their Bitcoin to 1% of their entire portfolio, or assumptions made regarding the total addressable market. But for retail investors, this is the most meaningful result to refer to. The graph demonstrates annualized volatility in the x-axis and the annualized returns on the y-axis. The portfolio with the lowest volatility consisted of 2.55% of the entire portfolio as Bitcoin. The result with the highest Sharpe ratio, which is a ratio that demonstrates the highest returns compared to its risk, consisted of 6.55% of Bitcoins for the entire portfolio. What's interesting to note is that despite Bitcoin's extreme volatility, due to its low correlation with other assets, it plays a complementary role in a portfolio. In a similar context, an academic research was conducted by Alativinsky, an economist at Yale, where he assesses Bitcoin using textbook finance tools to conclude the following. The first case is that if you believe that Bitcoin will continue to perform as well as it did throughout history, you should hold 6% of your portfolio in Bitcoin. The second case is that if you think it'll do half as well, you should hold 4% of your portfolio in Bitcoin. And for the last case, in all circumstances, even if you think it'll do much worse than it historically performed, since past historical performance is not a reliable indicator of future performances, you should still hold 1% of your portfolio in Bitcoin due to its massive potential returns. I've been a big proponent of Bitcoin and other cryptocurrencies for many years, and even from a realistic approach, this may be the best time to start looking into investing in cryptocurrencies. On the right hand side, you'll see the chart from the analysis that I uploaded on TradingView and on my website. This shows Bitcoin's logarithmic chart and how it undergoes phases of consolidations and bullish rallies. From a technical perspective, we are at the verge of ending a long phase of consolidation that lasted for years. Especially considering that investors should and are looking for hedges against inflation, Bitcoin offers a very appealing investment opportunity because it demonstrates little to no price correlation with other assets and securities. Moreover, the growing interest from institutional investors also suggests potential for massive corporate capital to flow into the market, which would eventually stabilize volatility in the long run. Risking 1 to 6% of your entire portfolio on an investment opportunity that could multiply is a calculated risk worth taking. As such, my final opinion on Bitcoin as a long-term investment is that it's a buy. Thank you guys so much for watching. This was the most comprehensive video I've done so far, and it contains a lot of information, so feel free to leave any questions or comments below. If you made it until the end of this video, please don't forget to like and subscribe for more quality content, and I'll see you guys in the next video.